Welcome to our quarterly market review for the fourth quarter of 2025. And it was quite a year in 2025. Trump, tariffs and trade wars, but the last quarter dominated by inflation, interest rates, and artificial intelligence. When we have a look at the chart here of the Australian and the US markets over the course of the year, you can certainly see the effect of tariffs way back in early April. And then when the tariffs were put on pause, markets were up and away. In fact, markets were hitting new highs all the way to the end of October. And then it all went kind of pear-shaped. And you see this great divide happening between the Australian market and the US market. Now, the US wobbled around in November, but sort of got back on their feet in December and ended up with a quarterly return of a modest but positive 2.7% return. The annual return for the US market, staggering 18%. Again, third year in a row of these outsized returns. Now, in Australia, you can see that while the US and Australia were pretty much correlated throughout the year, when the wobbles happened in November, while the US recovered, Australia did not. Australia kept going down. So the Australian market down -1% for the quarter and up, though, a very healthy 10% for the year. Keep in mind that 10% is greater than the long-term average of the Australian market. So all in all, not a bad year. Now, this behavior, this great divide between Australia and the US is not only evident in the equity market, but it's there in the bond market as well. When you look at the chart here, we're plotting US 10-year yields and Australian 10-year yields. Now, they've been correlated for 5 years, and we're only just seeing this great divide happening now. Now, because 10-year yields are going to be one of the biggest influences on the returns you're going to get out of a bond index, it's no surprise that if yields have gone up in Australia, then the Australian bond index has got a negative return for the quarter and a pretty modest return for the year. The global bond market, mainly made up of US government bonds, has got a positive return for the quarter and quite a good return for the year. So what's causing this great divide between Australia and the US market in particular over the quarter? It's all got to do with expectations around interest rates and inflation. When you look at the chart here where we're starting at 2021, that's when interest rates, do you remember this, were zero. And then interest rates in the US shot up higher and faster than Australia. So we were a little bit late coming to the party, but we've been more modest in the way we've gone down, where the US is coming down faster than Australia. So what's going on here? Well, the wobbles that we saw in the US market, which reverberated around the world in November, that was due to a plethora of economic factors. High US debt, worries about valuations in the US, particularly worries around the enthusiasm for AI. Inflation seems stickier than many were expecting, but the labour market was weakening. So there was a bit of uncertainty about which way interest rates were going to go in the US. But all that was put to rest at the December meeting, where the Federal Reserve cut rates by 25 basis points and indicated that they were expecting rates to come down once or twice more in 2026 and then even out to 2027. So markets love interest rates coming down. So if you like, the market rejoiced in December, particularly the high-tech stocks. They love low interest rates. And that's why the US took off again in December. In Australia, we wobbled around in November like the rest of the world based on a lot of that US economic data. But when the inflation print came in for September, which came in at the end of November, it was much higher than what the market was expecting. And so suddenly the thought of any more interest rate cuts in Australia was taken off the table. And that was the case when our RBA met in December. They kept interest rates on hold at 3.6%. So as these interest rates have come together, the Australian dollar has appreciated. The US dollar is actually falling against other currencies around the world. But as interest rates get closer together, the Australian dollar gets in higher demand, and we've seen the Australian dollar against the US dollar appreciate by around 8%. So how does all this play out for an Australian investor in a diversified portfolio? Let's have a look at the major asset classes. So starting with Australia, just reiterating, not much of a quarter, down -1% due to the reasons that we've talked about. But again, have to reiterate that it was a great year, up 10%, greater than the long-term average you get out of the Australian market. Over in the developed markets, dominated pretty much by the US, they make up about 70% of the developed markets. That's up just over 12% in Aussie dollar terms. And if you look at the developed markets on a hedged basis, because the Aussie dollar has appreciated, then the developed markets in hedged Aussie dollar terms up around 18%. And the emerging markets have had a really good year, up 25%. So what can we expect in financial markets in the next quarter or the next year? I really don't know. It's very hard to tell what financial markets are going to do. But the last quarter does give us a little bit of insight into the economic conditions in different markets. All the concerns that the US had in November around high valuations and enthusiasm for AI and a slowing labour market and high debt, all those are still in place. So they're weighing a little bit on sentiment in the US market. In the Australian market, yes, interest rates are off the table and markets got to get used to that. But the actual Australian economy is growing, it's quite steady, and we're not seeing any real issues going on there. So the only thing we can really say about financial markets in the future is to keep in mind that the last 3 years has been phenomenal returns, way and above in excess of the average returns that you'd get. So it won't be any surprise to see that there's some correction happening in 2026. I don't know when. I don't know why. I don't know how. But it won't surprise me to see a correction of some sort in 2026, but I expect it to be fairly shallow and to be fairly quick. So in other words, markets will wobble, but they'll recover pretty soon as well. Keep in mind that analysts have been saying for the last couple of years that the US market's overpriced and it's due for a correction. It hasn't happened. They've got it wrong every time. Now, I see that a lot of analysts are saying they expect the market to be another bull market next year. That's probably the biggest warning sign I've had so far. My advice: stay disciplined, stay diversified, stay in the portfolio that's been set for you by your advisor. I'm Steve Garth. Thank you for watching.